Good morning, everyone. Thank you for joining us. I hope you're enjoying the summer. It's been a relatively cool summer here in Toronto, but I believe we'll be getting some heat today from what the weatherman has been saying on TV. As always, I'll be joined by Gareth Watson, Director of Investment Management Group at Richardson GMP. Speaking of the heat, the stock markets have actually been quite heated up for the first half of 2014. The TSX and the S&P 500 have reached new highs and are hovering in record territory. With this in mind, I wanted to remind everyone that the last time we were at this level on the TSX was in 2007. So it's been a long time since we are finally back at these levels for the TSX. From an asset allocation standpoint, we have maintained our underweight weighting on fixed income by 5%. We are target weight our Canadian stocks. We've maintained our overweight allocation to U.S. stocks and actually have increased our weighting over the last 6 to 8 months in international stocks. The real surprise for the first half of 2014 has really been fixed income or the bond market, where many expected interest rates to rise when they actually declined by about 50 basis points or 0.5% in the first half of 2014. I'm going to quickly go through the numbers of the indices. The S&P TSX as of June 30th was positive 11%. The S&P 500 in Canadian dollar terms was up 6.5%. The MSCI Europe, Australia, Far East Index, which is non-North American, was up 3.4%, and the DEX bond universe, as mentioned, is up about 4.81%. Gold is up 9.8%. And our Canadian dollar to the U.S. today is hovering at about 93 cents on the dollar. In my opinion, we're looking at three things that could affect the market. One is a new recession. The second one is an error by policymakers. And the third one is an event-driven shock. Now, I personally don't foresee a recession in the U.S. and that the U.S. unemployment numbers are at their lowest in 6 years at about 6.1%. But Gareth will talk a little bit more in detail and provide us their views. We've seen the tragic incident that occurred last week of the Malaysian Flight 17 drive the market down one day and recover back in the next day. So it seems like geopolitical issues aren't necessarily affecting the markets negatively at this point. I'm now going to turn it over to Gareth to give us a little bit more detailed explanation of what happened the first half and what we anticipate going into the second half and what to look out for.
Great, thanks Frank, and thank you to everyone for joining us today. I'm going to have some brief macro thoughts here from a global perspective and then start to bring some of the things back home to North America in terms of the comments I'll be making, and then also get a little bit more specific about some issues that we talk about here in Canada, specifically the Canadian dollar and, of course, commodities. Most of my comments will be forward-looking as we look towards the second half of 2014 and moving into 2015. Just briefly going to start off with Europe. Europe has been doing obviously a lot better today than it was a few years ago, but at the same time there still are a number of risks present in Europe. But let me just first of all state the most important thing about Europe and the reason why European stock exchanges have done so well over the past couple of years, and that is the fact that financing costs remain remarkably low. Government bonds, the cost of issuing debt at the government level has been coming down. Essentially what happened, the European Central Bank back in 2012 made an infamous quote of saying that they'll do whatever it takes to ensure the stability of the Eurozone and to keep financing costs low. They actually really never did anything. They didn't have to do much to reinforce that because the market simply believed them and ended up buying up bonds and pushing yields low on their own. This is very key because, of course, the biggest issue in Europe a few years ago, if we want to talk about the countries such as Greece and Portugal and Italy and Ireland and Spain, the issue there was a financing issue. Costs of borrowing were going up. They were unsustainable. They weren't able to balance their budgets appropriately, and more importantly, by issuing more and more debt, that just put them on the hook for liabilities further down the road. And now it's a lot more manageable having interest rates a lot lower. In fact, Spain recently, and this actually is a bit troublesome, I think, has a lower yield on their 10-year bond than the United States of America, which doesn't actually make a lot of sense. So with respect to Frank's comments at the beginning about underweighting fixed income by 5%, he seems to be, I think, on the right track with that call. With that said, though, it does set up very well for a lot of these countries, periphery countries in the Eurozone that are trying to pick up their economic activity. Admittedly, the data that we've seen so far is not as strong as we would have liked to have seen. The good news is that Europe has come out of the recession. The bad news is that it's not accelerating, at least growth is not accelerating as much as we'd like to see. They still have a number of challenges there. Just because of the dispersion, you have one really strong country in that Eurozone being Germany, and then you have a lot of really weak countries. Another big country that tends in the past to be strong was France. They are struggling as well. So it's a bit hit and miss across the continent, but on the whole, the region as a whole is squeaking out some growth at this point, and we just need to see that accelerate. What has changed in the past few months, in the past quarter, is the fact that the European Central Bank has become more active. To be blunt, really, they haven't done much over the past couple of years. If anything, actually, they've been reducing the size of the balance sheet of the European Central Bank, while other central banks around the world, especially the Americans and the Japanese, have been expanding the size of their balance sheets, issuing a lot of debt. Not necessarily the case in Europe, and some were wondering whether or not Europe was being a little bit too complacent and not doing enough, but after the most recent meeting, they did announce that some policy changes are on the way. The market liked what they heard. In fact, they've even hinted that even further policy action will be taken to make sure that they support the Eurozone economy as a whole. So again, the outlook is encouraging because they have these tools at their disposal, but there still are a number of risks. And just on the next slide, I'm just going to show you the fact that, I mean, this is a great a graphic illustration of how borrowing costs have come down over the past 2 years. And this goes all the way back to July 2012, when the European Central Bank did say that they would do whatever it took to keep financing costs low. Basically, every single country has seen their yield go lower, with the exception, of course, of France and Germany, which have basically been flatlining ever since, but they're already so low, it's kind of hard for them to go a heck of a lot lower. But the problematic countries, if I can call them that, in particular, of course, Greece. Admittedly, let's face it, Greece, I think, declared bankruptcy twice in this the course of this chart. But as of right now, if they were to go to the market to issue new debt, they are issuing it at a cost north of 5%, as opposed to, of course, back in 2012 when it was 25%. And I don't need to ask you whether you'd rather be paying 5% or 25% on your borrowing.
I think in a couple of years ago, we were having our last presentation. Greece was well over 25% in borrowing costs.
And essentially, 25%, they went bankrupt. I mean, nobody really wanted to say the word bankruptcy because there's a lot of legal implications that come with that. But essentially, what they like to say, of course, is that Greece renegotiated their debt. That is basically code for, hey, we went bankrupt, and to our bondholders, sorry. Anyway, you'll take whatever you can get. Just jumping over to Asia, China always topical. China, and I think I've talked about this a lot in past WebExes here with Frank, that China is a country in transition. It's in a multi-year transition. It is a country that historically has grown on the back of export activity, grown predominantly on the back of industrial activity. Here we see a country now that realizes that they cannot continue to grow solely on that type of business, that they need further diversification of their economy. We are starting to see signs that that's happening. For example, the services industry grew more than the industrial side of the economy in the past data that was released. This has actually been the case for the past 5 quarters, and that's a very good thing, because that means when you see service industries going up, it usually results, hopefully, in higher wage pressure. Higher wages, of course, mean to more disposable income, and hopefully more disposable income leads to higher consumption. And that's what the Chinese government would like to see, is more internal consumption in China. It certainly has a lot more legs to go here before it becomes far more influential in the composition of Chinese growth. But these are the types of things that China is trying to accomplish through their policies, whether they be fiscal or monetary policy, because although it was great to grow on the back of exports for so many years at such high rates, they knew it was unsustainable and that changes were needed to make sure that at least the growth remains intact without basically falling off a cliff, which can easily happen to economies that rely quite heavily on exports for growth.
So have we, is it safe to say that the world has adjusted to lower growth in China?
To some degree, yes. in that, well, I would argue perhaps Europe not as much, because Europe, or I should say China, is Europe's biggest trading partner. So unfortunately for Europe, I mean, they got hit twice. They got hit because they screwed up themselves with their own internal finances. But then, of course, they had to deal with a weaker China. And when your biggest customer is weaker and you're already struggling internally, it's kind of a double whammy. So perhaps some of their neighbors that surround them have been able to adjust, maybe, but countries like, or I should say regions like Europe, and also to a degree Australia. Australia very reliant, particularly during the commodity days of 2005 to 2008. A huge trade going on between those two countries. There probably has been some adjustment, but at the same time also there's been some pain because of that.
And Canada has adjusted fairly well, I guess.
Yeah, I mean, the thing about Canada, for example, we never really exported oil to China. So while China set global prices in terms of direct trade with China, admittedly we were probably more on the agriculture and the metals side and perhaps the lumber side. Our impact, or the impact to us, was not as strong as, let's say, in Australia, where there was a lot more direct trade in resources. But yes, because China did tend to set global pricing, we did have to adjust in some way. Admittedly, if you look at the areas where you think would be hit the most, which would be the prairies and BC, they continue to be the strongest performing economies in the country. So I guess I could conclude, yes, they've adjusted just fine. But that's also because, not because, or I should say they didn't have to adjust much, because oil prices haven't gone down. Even during this economic downturn, yes, we had some weakness. We got down to the low 80s, I believe, at some point in the past 3 years. But look at oil prices today. Even if Chinese growth is, now it's 7.5% as opposed to 13%, you still got oil at $100 a barrel. You've had natural gas have a bit of a lift at the beginning of the year. Admittedly, it's come off since. So there hasn't been as much adjustment as you might think, because global pricing has actually held in reasonably well. Just a couple other comments here on China. There still is some signs of weakness in the housing market. This has to do with a lot of the lending standards changing. The government, so bottom line is with China, the government is really trying to influence the way investment works in China. And the previous government tended to take the approach that they would invest at all costs to get growth. Always a lot of talk about fudging the numbers in China, but the biggest concern in the past was that this growth that we saw, whether it was 13, 12, 11%, was based on just a whole lot of money being thrown at the economy and hoping that everything works. Well, they did invest tons. They did produce growth, but unfortunately the returns on that investment is probably what's more important, as opposed to the growth that it produces initially. And the returns aren't necessarily overwhelmingly positive. So the new government is basically saying, look, we have to be more targeted as to where we put our money to generate better returns on investment for the long run. And what that has resulted in is more targeted investment, which means less investment on the whole, but hopefully generating better returns. The problem there is that when you reduce investment at the government level, that means that those entities that used to receive funding that no longer do now have to go what we call the shadow lending market, which is not controlled by the government, which is a little bit more dangerous and which has higher interest rates. So there are still some financial concerns in China about the way that country is operating in terms of generating investment and growth. The government is trying to get a handle on it. Again, this is a multi-year transition. We're certainly in the midst of it. And at this time, it would appear as though the transition is at least proceeding. I'm not going to call it proceeding well. I'm not going to say it's been a disaster. It's kind of in the middle road right now. But my point being is that there is still a risk there that things could change for the worse in terms of lending, which of course really is what is fueling a lot of the growth in China right now, which of course they're trying to change. The United States, if we return here to home in North America, it is showing signs of strength. And most of you are probably familiar with the employment numbers that have been coming out, quite strong recently. The unemployment rate down to just north of 6%, which is actually very close to the some of the averages of the past. So we can't talk about the record unemployment rate anymore, even though I think actually the unemployment rate is a terrible indicator. The actual number of jobs is more important. The unemployment rate is biased by the fact that people that aren't looking for work aren't included in the survey. which really doesn't give us a true sign of the employment picture in the United States. But at least more jobs are being created. Other things that are very positive for the United States, monetary policy is still very accommodative. Interest rates are low, money is cheap, even with some of the tapering of bond purchases that's going on by the central bank. And the fiscal picture actually is very strong. If we were chatting, I think now it's just over a year ago. No, actually it's even longer than that now. It's about 1.5 to 2 years. We went through the whole process of sequestration in the United States. Long story short, what it was a process where neither side could agree, and they forced each other into some really difficult tax increases and cost cutting. And then by disagreeing, they actually did themselves a favor, because the deficit in the United States has fallen from about 1.1 trillion down to just under 500 billion in the course of like a year. It's pretty remarkable how the deficit has been slashed, which means that the reliance, I think, on the central bank has declined, which means that's why we've seen tapering. Bottom line is the U.S. government's in a better picture, or in a better position right now from a fiscal standpoint, as is corporate America. Balance sheets are strong. We are seeing decent earnings coming out. We are seeing decent sales growth. In fact, I was just reading a comment from one of my colleagues this morning. He's noting the fact that this quarter so far, with about a quarter of companies reporting on the S&P 500, this is the best quarter that we've seen in a number of quarters for both earnings and sales growth. Earnings growth is about 10% year over year. Sales growth is about 3%. So it's pretty strong, and that's important when it comes to the markets, which I'll get to in a moment. Monetary policy with respect to the Federal Reserve, I'm going to sound like a broken record if you've heard me on this WebEx before. We don't see any rate hikes in the near future. 2014 is out of the question. The Fed is hinting at about, at some point in 2015, we'll likely see rates go higher. We're thinking more the second half of 2015. They have essentially come out and said that they hope to have the tapering process wrapped up before the end of the year. In fact, some people speculate it could be as soon as September, quite frankly. But remember, tapering just means you're not buying as many bonds. That's an influence of trying to keep rates low by buying up bonds. That doesn't influence the overnight lending rate, which is not expected again to increase until 2015 at the earliest. Bottom line here for Americans is that rates are going to be lower for longer. However, we will start talking about rate increases, and when that happens, that usually means things are good. And when things are good, that usually means that bond prices go down, which means that yields go up, which means that interest rates and borrowing costs go up. So be prepared for the fact that in the United States, yields are likely to rise in the next year, and for that reason, let's face it, if you have an increase in yields of 20 to 50 basis points, it's not going to knock the U.S. economy off its feet. But there will come a time, whether it's the overnight lending rate or just yields in general, going up hundreds of basis points where the impact will be greater, and that's where people will start positioning their portfolios differently, but we don't see that happening in the next year or so.
Thanks for addressing that. I wanted to be clear. I want the listeners to be clear on the key difference between the overnight lending rate and the long-term yields, where they have more control of the shorter-term rates, because they can make that decision right away, while they're controlling the longer-term rates really by bond buying.
Correct. That is correct. So let's return here to home. Canada, fiscally speaking, we have essentially balanced the budget. Technically, we haven't. We have a $3 billion deficit this year, but that includes a $3 billion contingency fund. So yes, we've balanced the budget. Going into 2015, I have absolutely no doubt that the Conservatives will find every way, shape, and form to spend the potential surplus that we're expected to have next year, especially with an election coming up next year. But bottom line is, fiscally speaking, at the federal level, we are in decent shape, but there is a bit of a cost here. I think that there has been some cutting in areas where it would help the Canadian economy, such as research and development, such as training. And for that reason, I think that we have to reevaluate where some of these cuts have happened in the past, where Canada was a leader, and perhaps reinstitute some of that spending for investment for future growth. However, with that said, the job market is still reasonable. It's always variable. The Canadian job market's, 1 month it's great, the next month it's bad. On the whole, though, I would say that it's marginally okay, in that some of the jobs that we're creating now, unfortunately, are more part-time than full-time, and we have to pay attention to that because we want people with full-time jobs as opposed to working 2 or 3 part-time jobs. We're in the same boat as the Americans. We're not expecting rate increases in Canada in this year. And to be honest with you, sentiment right now in the street is that rates are likely not to go higher in Canada before the United States now. It used to be that our economy was doing better. People expected our rates to go higher first, and therefore the loonie certainly was supported for that reason. However, that sentiment's changed over the past 6 to 8 months. The expectation now with the American economy growing better than ours is that U.S. rates could move higher before the Bank of Canada decides to increase interest rates. But again, this is all something that we're looking at the second half of 2015 at the earliest, and certainly not in the near term. The biggest risk, though, and I believe I've emphasized this before on WebEx, or on WebExes with Frank, is we are different than the Americans because, number one, our economic cycle started before theirs in that we started to grow again before the Americans did. Why? Because they got completely knocked off their feet. Their financial system collapsed. They had to spend a few years fixing that and then starting to grow the economy again, while we started to grow pretty soon after the recession of 2008, 2009. Second, and more importantly, Americans have been forced, whether they liked it or not, usually it's because they've been forced to liquidate, to de-lever. In other words, they had a lot of debt, consumer debt, and those numbers have now come down, although they're starting to go back up again. But there was a period of deleverage, which of course didn't help their economy, but it did make personal balance sheets more manageable. Canada is completely the opposite. We never delevered. Our consumer debt never went down, and all it's been doing is going up. This could be setting us up for a worse recession next time compared to the United States, because there's going to be a lot of Canadians when rates go higher that are simply not going to be able to afford the debt that they've got. Now, I'm not trying to scare people. I'm not saying that there's hundreds of thousands of people that are going to be out in the street because they can't afford their debt. Admittedly, it depends on how high rates go as to how many people will be impacted by this. But the affordability of debt is only going to get more expensive here over the next 5 years. Canadians need to be prepared for that and need to examine where their debt levels are, because they could be caught very short. And this really does speak more to the young people. I'm not concerned about baby boomers who have likely already paid off their mortgages, who probably have very small lines of credit. I'm concerned about the 18 to 30-year-olds or 35-year-olds who somehow have a big house, 2 cars, a cottage, and of course a skidoo. It doesn't make sense to me, but whatever. Thank goodness for that line of credit. Just a couple last charts here on Canada commodities. I just wanted to highlight where commodities are. They're fairly supported this year. That's probably why you're seeing the TSX up. We're still weighted about 50 or 45% towards materials and energy. Nickel, that's a bit of an outlier there. Nickel prices have jumped up because of some of the political uncertainty in the Russia-Ukraine area. Russia actually a big producer of nickel on the planet, and with sanctions, certainly that has pushed some speculative premiums here on nickel prices. So let's just ignore that. But the other commodities still doing relatively well, except for, I guess, copper and wheat. But energy still holding up very well, and of course energy was definitely a leader there earlier in the year for the TSX exchange. Speaking of which, this is the market. We were waiting forever for the market to break out of 13,000. It was stuck there, I think, for at least 2, if not 3 years, between 11 and 13,000. And ever since we broke through it, we have been obviously taking off, which does have some investors concerned. One thing I wanted to highlight is I talked earlier about profit growth. At least I've noted that the S&P 500, the profit growth there is about 10%. There's a pretty good correlation between stock market performance and profit growth. So if profits continue to rise, it certainly makes it a lot easier to justify valuations where they are today. The conclusion of our group with the analysis that we've done is that valuations are not cheap, but they are also not overly excessive. In fact, a lot of data out there shows, especially when you look relative to earnings growth, that stock markets are fairly valued, actually, not overly priced. So it certainly is some data to fall upon that says, look, what you've seen actually is a fair depiction of where stock prices should be, and is more of a reflection that in the past we far undervalued the markets as opposed to us now overvaluing them. In other words, saying that 2 years ago markets were fairly valued, now they're overvalued. Some are arguing, look, 2 years ago we were saying that markets were undervalued, and now we're coming back to fair value. So it is easy to get spooked because of how well the stock markets have done in the past year, but at the same time, there are some underlying fundamentals here that I think support where prices are. I've just talked about earnings growth, but again, I'll get back to monetary policy. Money's going to remain cheap. Markets love cheap money. That's not going away anytime soon. And then just corporate balance sheets, fundamentals, fiscally speaking, government budget. I mean, just there's a lot of things improving here that I think speak to where stock prices are. Now, with that said, there's always the chance for a pullback. We can never, ever 100% dismiss the idea that the markets could pull back 10% after a very impressive run, which has been going on essentially for a year now. And I can't dismiss that. However, we still think that this cycle has legs, and because of that, if we do get that 10% pullback, we would be viewing it more as a buying opportunity than as a reason to reduce equity exposure. And the last thing I just want to talk, or got 2 slides left, but the last Canadian component here is the Canadian dollar. Essentially, our views on the Canadian dollar, it's policy-driven more than anything else. The big decline at the beginning of the year, again, this goes back to what I talked about earlier, that the expectation now is that the U.S. will move rates higher before we do. That knocked the socks off of the Canadian dollar and the loonie. Since then, we've had a little bit of support back in the loonie, mainly because we've had some support in commodity prices, but we think the market, at the end of the day, will turn back to policy makers to determine where the loonie is headed. We think that the Canadian Central Bank, the Bank of Canada, is less likely to move first. Therefore, the bias here still is for a weaker loonie going forward. We could easily retest 90 cents this year, if not go lower. And especially if talk starts to swirl that rates are going higher in the United States sooner than expected, that's definitely going to take a toll on the Canadian dollar.
So probably about, the view would be in the 90-cent range if that were to...
Thereabouts, yeah. And in other words, my point being is don't expect this loonie to go back up to parity. That's not happening. We don't expect it. We would be shocked if it does. And chances are if it does go back up to parity, it is because commodity prices have gotten way out of control. Or, quite frankly, probably the Bank of Canada makes a policy blunder and moves on rates before the States, which we don't think would be very prudent right now, considering where our economy is relative to our American neighbors. The last slide here, I just wanted to highlight, we did produce a publication last week. It's our Market Outlook Quarterly, which you can certainly get from Frank at any time. It's a quarterly piece that we put out. It's about a 10-page report where we just talk about themes for the quarter, looking ahead from a number of different perspectives. But just the main themes, number one is that complacency still abounds. That just means that we're seeing markets that we feel are quite complacent right now. Volumes are a little bit lower than usual. The VIX, which is a volatility index, is very low, which is unusual. Usually when we see some of the indicators that we're seeing the way they are right now, it does tend to lead to a bit of market weakness. It's not to say that that's a guarantee, but historically speaking, when some of these indicators have not been as strong, we tend to see a little bit of market weakness, so we raise those points. I've mentioned here longer term, we still think that this cycle has legs, so that's basically saying, look, even though you could get a short-term pullback because of the complacency, there's a number of factors contributing here that could help support markets still for the next year. America, we've seen better data. We think even better data could be coming. We're in a cycle here where corporations are doing well first because they cut costs a number of years ago. Then they supported stock prices by returning capital to shareholders, increasing dividends and buying back shares. M&A activity now is supporting equity valuations, and there still is another leg to drop, we think, because we believe that corporate reinvestment has been very low, and we need to see some of that in this cycle, which means corporations putting money back to work in their businesses, and that will help grow the economy as well. So lots going on there. And yes, the Canadian economy will benefit from any type of growth that comes out of the United States, but we emphasize our caution once again of consumer debt levels. And as such, we have to be a little bit more cautious here about how we go into our next recession. Recessions will happen. They're inevitable. It's just a matter of how short they are and how painful they are. But we're setting ourselves up a little bit worse, quite frankly, than the Americans are because our consumer debt levels are certainly higher. So with that, I will turn things back to Frank.
Thank you, Gareth. As always, great insights looking to the latter half of 2014. And based on this information, any allocation changes that we'll be doing where we're reducing the stock or equity exposure in client portfolios over to cash or fixed income would be done, rather than out of fear, but out of prudence. And we're still very comfortable with the economic and market fundamentals. My concern is that it seems like people are looking for a reason for this market to go down. But it looks like at this point that investors are looking to buy on the dips. And as Gareth has mentioned, if and when there is a healthy correction, that it's an opportunity to reallocate back into equities. Corrections are not necessarily a bad thing. In some cases, they're a good, healthy approach to things. In closing, I want to say thank you again to Gareth and for taking the time today and discussing his views going forward. And I want to thank all of you for joining us, and I want to wish everyone a safe and happy summer. Thank you.